Yes, sir.
Okay. So today we'll be seeing in the second session the key financial ratios. There are three parts. So we'll be seeing the growth and profitability ratios. These lectures will be useful to you basically because over a period of time, when we keep on doing the fundamentals along with the charts, you can have an understanding. These are the ratios which one should look at. The growth and profitability ratios, which is what we are going to cover today. Then we'll see, we have seen this company profile and all, we'll see as a part of your analysis of your management point of view, the financial statements point of view. Then leverage ratios regarding the debts, activity ratios, how efficiently the company is being managed.
Excuse me, we are unable to see your slide.
I'm able to see it.
You're able to see now?
Yeah. Actually, what you can do, you can refresh or you can come out and again join.
Okay, I'll do that. Is everyone able to see?
Yes, sir. Yeah.
Okay.
Yes, sir.
So these are the ratios one should look at. So today we'll be looking at the growth ratios, the profitability ratios. This is the overall which you can understand from your annual reports, your yearly reports, balance sheet annual reports, PLM and cash flows. Efficiency activity ratios will tell you how well you're running your company from inventory point of view, accounts payables, accounts receivables, working capital ratios. And this will tell you the money flow which is coming into your company and something which is going out of it. Valuations will help you to understand whether you should buy at this level or not. Okay. So we'll see this today. The first one, growth and profitability ratios. The financial ratios help us to connect the dots. It helps us to see when we should buy a particular company. Looking at the growth of the company, the sustainability, last 3 years, 5 years, क्या कर रहे हैं, business क्या है, आगे जाने वाला है, whether it will do well, whether the profitability is good, whether ROC is good, whether ROE or ROIC is good. Then we'll see how much the company is having the debts, the long-term debts, the short-term debts, the leverage ratios, also called as solvency ratios. This debt will tell me whether I'm investing in a company which is very highly debt driven. Some companies are there like Adani's and all. Management running the company profitably, effectively, activities are good, very well managed. Is the stock price valued properly? Am I looking at fair value stocks only or undervalued? Today we saw one stock which was at a quite undervalued. And management quality and the promoter and the shareholding, one can understand from the annual reports of the company. Growth indicates how much the company is going, how much fast the company is growing. It tells me whether the company will be able to sustain. There was a time when people used to look at buy and hold, but now buy and hold does not work. Maximum you will have to look for 2 or 3 years, and every quarter if you keep on looking at your portfolio, you will do a better job. And another thing which I have learned in the last 2-3 years is we have to book profits as well as losses. We become very greedy in our profits. I became greedy in the metal stocks, and suddenly government put that levy. Now I'm holding it till the time the government will remove the export duties, and that is the time when the metal stocks will start moving up. So we'll see the sales or revenue growth ratios, and secondly we'll see the profit growth ratios. So let's see at the sales or revenue growth ratios. This is the part of your income P&L statement, very first line in the statement. Look at the historical growth. Look at the same company peers in that group. Look at the market leader, market runner-up, and see where you belong. The formula is revenue growth is in percentages. Current year revenue minus previous year revenue divided by previous revenue in 200. In Excel, we have this formula. Okay. Check your sales or revenue growth for the last 3 years, 5 years, and 10 years. This is available on screen also easily. Revenue or earnings growth, if it is in the range of 8 to 12%, is good enough. In the range of 10 to 15% is quite good. In the 10 years range, it should be around 10%. Okay. For a growing company, the revenues will be consistently increasing. Many of the mid caps are showing that kind of movement. So if you, sometimes we happen like we had this COVID year, and suddenly you found some of the companies, they have done bad in this COVID year. What we saw just now, Radico Khaitan. So don't get worried about that one-off things, because that is possibility which can happen for any company. Large cap sales growth expect to be around 8 to 10%. That is consistent. Mid cap over 10% is good. Sales growth is a measure. You should be looking at TTM, trailing 12 months basis also. Because sometimes when you are in the middle of the year or beyond that middle, 8, 9 months, then TTM will give you a better idea than the previous year figures. Profit growth, second thing. See the profit growth over the years. So sales and the profit should move in tandem. If the sales is moving and the profit is not moving up, that means their expenses are high. Look at the historical profit growth, look at the peers and similar size company. Profit growth is once again similar to your sales, same kind of formula. Current year profit minus previous year profit upon previous year profit into 100. If you look at the top line, we are talking of the sales growth. If you look at the bottom line, we are talking about profit growth. If the company's revenue is increasing, that means turnover is increasing. It does not mean that the company profits will increase. Currently, we are seeing FMCG company margins are not so up because of the expenses are going up. If the profit growth is high, it means the company is doing well. It is able to control the expenses, and expenses are much lesser than the sales. It is a growing company. Normally, for a 3 year, we look at a profit growth around 10%. A business having a good economic moat, like just now what we saw, VBL, Varun Beverages, they are having consistently increasing profits and sales. Some of the companies we will look at. So let us see Hindustan Unilever, Asian Paints, TCS, Tata Steel. We saw Tata Steel. So let's see some of them and then we make some judgment. Here is Hindustan Unilever. ROCE, ROE, good. PB little high, stock expensive, intrinsic value around 870, current price 2304. It is a market leader, no doubt it has to be expensive. This all that are telling me it is good. PEG ratio is little high, around 1.5 to 2. It is little difficult to sustain the earnings growth. See here, the PE ratio median line is around 67, and today the stock is around 60, 55, sorry. Still it is high. The growth is poor. You can see here. Last 5 years, 10. This last 12 months, it has increased. Okay, here it is around 13 and 16%. Last 12 months, it has gone down, profits. So sales has gone up, but the profits have gone down. What do we indicate? Margins are coming down. The stock price is negative. Last year, the return on equity is less compared to the 3, 5, and 10 years. See the peers. See here. See the sales. See here. Because on this low base, this was high. But because on the high base, this has become low. See, the expenses are increasing tremendously. The margins are reducing. The profits are reducing. See the quarterly figures. This is year-on-year sales growth. So currently, Hindustan Unilever is going through a problem of margins getting affected. Margins getting affected. They have increased the prices, but still, I saw the interview also on the MD of the company. I forgot his name just now. So he also mentioned the same thing. The margins are getting affected. The profits are going down. And it is a worldwide phenomenon, which is true. Still, the ROCE is good. Okay. When there are debts, you should look at the ROCE levels. If the company does not have much of a debt, you can see ROE and ROCE will be very similar. So that was Hindustan Unilever. Let us see Asian Paints. Stock is high, costly, very costly rather, very, very costly. Okay. If you see Berger Paints, Kansai, Nerolac, everyone is around 600, 700, 500. Whereas Asian Paints, the market leader is 2761. Very, very high. There is a pledging here. That is one of the negative factors. Promoter holding is 52. Profit is down. You can see here. Once again, the oil prices impact is there on the profits. Here you can see the PE is, the average PE is around 65 and this fellow is around 86. Okay. The cost is very high. That is one of the major problems. See the PE, the peers comparison. See the prices. See the sales growth. Less current. Okay. See, it was here 90%, 43%, coming down, still further down. Profits, it has gone down. Expenses, material costs gone up. Definitely, crude oil is one of the major ingredients. OPM, operating profit margin, relatively good, 18%. September 21 was down. This year is better. But if you see the previous quarters in 20, when it was market was doing well and all, it was around 24, 26, 20%. PBT is slightly low. Net profits, EPS has come down. This is quarterly EPS and this is yearly EPS. See the sales. We are looking at Asian Paints. Last 12 months, it has now started moving. Profit growth is negative because of the margins are going down. In the last 12 months, it is down. It will come back, no issue. Price is down, definitely it is down. So we saw this. Let's see some negative company. Let's see Godrej Properties. Somehow I like this company, but unfortunately I bought it at a very high level, somewhere near 2000 levels, 1700 levels, sorry, 17, 18 levels. And now I'm finding this company not moving. They made a lot of claims. But after that, the business has not done so well. But believe me, many FIs are holding this stock, many DIs are holding this stock. So the intrinsic value is just 178 and the stock is showing 1200. Very, very high. Stock P is 95. What about the sales? See here, all negatives are more. You should look at all these things. See all the real estate companies. See the P's. GR Infrastructure is low, but still it is not a good company, so I won't invest. Prestige is good. Oberoi Realty is good. DLF is also quite high. Let's see the sales on a quarterly basis. Looking better. Current quarter is better. Profit current quarter is better. December it was negative. September it was negative. Operating margin has improved. Positive mein hua abhi. Net profits has increased. That's positive. So the company is actually improving basically, if you see. Here it was negative, March 20 and March 21. Now it is improving. We are looking at Godrej Properties. Operating profit last 2 quarters, last 2 years is negative. This is March 22, this is March 21. Net profits this year is positive. See the growth, sales growth, it is increasing. 3 years it was negative. Profit growth, it is increasing. Okay. Price has gone down by 14% in last 1 year. ROE is 4%, which is bad. Okay. Cash flows, negative cash flows means पैसा ज्यादा expense हो रहा है operations में and पैसा return कम हो रहा है. No major expansion activity, no investment activity. Okay, you can see that. So Godrej Properties on the whole, I am having it, I will hold on, but I will not buy. It is not looking nice. Okay, even though people will keep on forecasting these numbers, that will be in good days and not in current days when the market is in a bad shape. Any other stock you want me to look? Tata Steel we saw. Zomato, let us see Nykaa. I have not seen Nykaa for a long time. I was reading on Nykaa. That is what I want to see. Fundamentals are relatively okay. Let me see here. And then come and see back what I see here. Nykaa intrinsic value last year कुछ था नहीं, अभी 1436 है. Stock P 1600 times. मतलब बहुत ही ज्यादा कॉस्टली है. PB 50. Industry P 42, 1658. Earnings per share hardly anything. Promoter holding is good. Sales growth is good. Petrosis score is bad. CMP, FCF, free cash flow is bad. So I will not go for this stock, but many people are buying this stock because they expect like Zomato, Policy Bazaar, then Paytm, they expect future earnings to be good. But what happens if it is not good? Then it is better go as per your data and buy as and when you find the stock turning around, even if you have to pay a little more. See here, it is not the one I will buy. Zomato not showing me any P values because earnings in here. Info Edge, I am having this stock, but I am finding uska job except Naukri, even PB is not doing well. Policy Bazaar. Paytm, India Mart, I have exited this stock with a loss. Just Dial, So what do we do? It is better not to go for now. See the sales. Sales are increasing, good. Expenses are increasing, very good. That's negative. OPM, operating profit margin. See here. See here. In the last few quarters, say from last March onwards, OPM is 6%, 3%, 3%, 6%, 3%. ये कोई profit ही नहीं है. Net profits, hardly anything in crores. Earnings per share, nothing. Yearly, if you see, sales are increasing. What about my expenses? Expenses also equally increasing. What is my OPM? 4%, 7%, 5%. ये level पे business हमेशा तकलीफ में आ जाता है. But people will wait, will buy, and then they will realize, see the 3 years sales are going. Where are the profits? No, this is not possible because abhi market mein hai. But ROE definitely down. So not at all happy with such companies. Wait for the time. Maybe if you want to do swing trading, ये forecast high है, ये ऊपर जाने वाला है 300 रुपया, वो सब आप कर सकते हैं. But if you're looking for your portfolio point of view, not at all. Let's see the next one. Profitability ratios. Analysts use this to measure the ability of the company, how much profits it can generate. We have operating margin. We saw operating margin just now. Net profit margins. We have return on equity and we have return on capital employed. The last one we'll see is ROIC, based for the investors basically. Operating margin. What is operating margin? Sales minus the expenses gives me the operating margin. And the percentage of with respect to sales will give me the operating margin percent. Okay. So sales minus expense will give me the operating profits. Divide by the sales will give me the operating margin. Okay. Some of them look only at the profit before interest and tax. Some of them will look PBIT, DA figures. If the revenue is increasing and expenses are more than the revenue, we found some of the places OPM was negative. Operating profit margin was negative. It will vary from industry to industry. So always compare with the peers and look at the top fellow, the market leader, and benchmark it against the market leader in the same industry. Why a company is doing well and why a company is not doing well, you'll be able to know from the company's OPM vis-a-vis the top performer within the industry. So let's see the first ratio. Profit before tax divided by sales percentage into 100. Anything around 10% is good. Below that is not so good. Anything about 10-15% in the last 3 years is good. Below that, it is okay, depending upon the conditions, the market conditions. Net profit is nothing but you take the final profit after deducting interest, tax, depreciation, amortization, everything. For valuation point of view, use PBT. For picking up the stocks, you may use PAT. ROE is one of the measures of profitability of a company. Net profit divided by the amount of money invested by the shareholder into 100. Shareholder capital is also called as share capitals plus the company reserves over the years. 15% to 18% above is good. Less than 10% is not so good. 25% means what? If you are invested ₹100, you are getting 25 as returns. Compare ROE of the same industry and the peers. Compare ROE with the industry average. Industry average. Okay, if a company is having debts, if the company is taking loans, having liabilities long term basically, then look for ROCE figure and not ROE figure. I'm giving you the example here. Here is my company A, net profit 20%, shareholders equity 100. So 20 upon 100 into 100, that will be giving me ROE of 20%. Now, instead of 100 equity, the shareholder puts 80 and takes a debt, a long-term and a short-term debt of rupees 20. So what will be my ROE? Net profit divided by shareholders equity. Now shareholders equity is only 80 because he has taken a debt. So in such a scenario, you will find that the ROE is showing to be increasing. ROE is telling me here 20 and here 25. It does not mean that company B is doing better than company A. It actually tells me that this company B must have taken some debt. And that is the reason company B looks to be better. But it is not, because it has to pay interest loans. Till the time you are in a position from your free cash flow, the money coming in, if you are able to pay your loans, you are better off. If you are not able to pay your loans, it is better not to take the loans. If the company is able to manage the interests and payouts, it is good. Otherwise, the company can have a problem. Take another company, B1 and B2. Now, company investor is putting 60 and the loans and debts are now 40. So 20 upon 60, ROE is 33. Is company B better, B1 better than B? पहले वाला 25 था, अभी ये 33 है. So 33, you think it is better? No, because he has taken more debts. अभी कंपनी B2 लेते, इसका खाली इन्वेस्टमेंट 40 है, but debt 60 है. तो अभी आपने क्या किया? You are saying that 20 upon 40, my ROE is 50%. Is my company B2 doing much better than B1 and B and A? No, not at all. Why? Because I have increased my debt. My loans have increased. Company B2 may not be better than B1 in case it is not able to service the loans. I have some companies in mind, but I cannot name them. So company B2 is showing excellent ROE figure, but it has to pay more loans. Where it is going to pay the loans from? Is it having free cash flows? The company B2 may find it difficult to carry on the operations. The company B2 may become sick over a period of time. The company B2 may close the operations. Please understand this. So, if you are having a lot of debt on your balance sheet, then definitely your ROE will show good, but ROCE will show that it is not doing well. Company will fail to pay the money. It will struggle to pay the interest on the loans. So a company should have a proper balance sheet, a proper balance between the money invested and the long-term debts. Debt to equity ratio, if it is exceeding 1.2, maybe okay. Above that, bad. Okay. Similarly, price to earnings divided by earnings growth, PEG ratio, can be around 1.5. In one of the YouTube videos, one of the big investors has mentioned, I don't mind taking PEG of 3. But today, that same investor will say it was not appropriate at that point of time. So ROE is not the answer to the performance of a company if the company is having a lot of debts. Remember this, ROE, agar debt hai to lena nahi chahiye. You should look at ROCE. So let's see ROCE. So what we do in ROCE, we look at the debt of a company. So we see the overall capital employed. That means shareholders' equity plus the debts. So the denominator is now having equity plus long-term debts plus short-term debts. So both are good, ROE and ROCE. But if you see ROE is high and ROCE is less, you should immediately understand that this company is having good amount of debt on the balance sheet. ROCE, like ROE, above 15, above 17, 18. In one of the Peter Welch books is mentioned 17 is a good number. 8 to 10, it is poor, not worth investing. Whether you should go for ROE or ROC, as I told you, ROC greater than ROE, company is using debt and using it intelligently and making money. But if ROC is greater than ROE, debt can help the company to do well, provided you are in a position to pay your loans from your earnings of the operations. Okay. If it is above 18-20, then such companies, as per Warren Buffett, they are very good. As per Peter Welch, it is around 17. So anything above 15, 17, 20, you can consider to be good. If there is a divergence between ROE and ROC, ROC ज़्यादा है, ROE कम है, or ROE ज़्यादा है, ROC कम है, normally it will be ROE ज़्यादा and ROC less. In such scenarios, you should understand that there is some amount of money which is on loans and the company is finding it difficult to pay back. A company can have low net profit margin but high profitabilities. That is a possibility because of this ROE and ROC. Then we have something called as ROIC. We look at the invested capital. If it is investing and makes money greater than the average cost, then that company is doing better. So ROIC is used as a benchmark when we compare with the peers. If ROIC is greater than 2, company is creating value. If it is less than 2, there is a problem with the company. It is getting destroyed. So these are the figures of 2021. You can go to any of the sites, you can get these figures. Okay. Let's see some of the figures of some different companies. First, I'm seeing TCS. ROC 54, ROE 43. Slight depth is there. This is high. P is also slightly high, but it has come down from a very big value earlier. It was as high as 40. It has come down to currently at the 31 level. The median line is somewhere 26.1. ROC, such companies are very strong companies. Sales, profit margins, net profit. All these are telling me the company is doing relatively very well. So should I sell TCS? No. Will TCS grow at 17, 18, 15 plus? No. TCS will grow around 10, 12, 14. If you are getting 10, 12, 14, it is good. I was referring to some webinar where it was mentioned that anything above 9 or 10% earnings on your portfolio is good. And if it is getting 12 or 14% in a stable company, large caps like Infi, TCS, it is very good. In mid caps, you can get 15, 16, 17% like Mindtree, L2IA, LTTS. So always be having a portfolio allocation such that you are able to maintain a balance in your earnings. Has to be there. Earnings has to be there. Overall earnings has to be there. See here, most of the IT companies are coming now to good valuations. The PE are relatively well. Intrinsic value is quite okay. Still PCS being the market leader, it is high compared to Infi, HCL Tech, HCL Tech and Tech Mahindra. You can see this and this. They are the lowest. Okay, they are the lowest in the P valuation point of view. So they are fairly valued. Fairly valued. See here, HCL Tech intrinsic value is 893 and here it is 966. Here it is 229 and here it is 418. Here it is 666 and here it is 981. Just 1.5 times, 1.1, 1.2 times more. Okay. So let's see here. TCS, fundamentals good, valuation expensive, technicals. So currently it is on this side of the chart. See the peers. Net profits, operating revenues, price to book value, see here, we are looking at a big set. All are going down. But my thinking is you may not get the similar returns what we got last year, 15, 17, 18%, but we will definitely able to get 12, 15%. So if you're having large caps and high end mid caps, hold it. The lower ones, you can think about it as per your stock, at what price you bought and how much you can wish to sell or not. So anything you want me to go through or something which you want me to evaluate a particular stock, please let me know, or we'll close for the day.